There's one decision retirees make during market drops that can quietly cut their portfolio in half. And the worst part? It feels like the safest move you can make. Because when your account is falling, when the headlines get louder, when you're down more than you're comfortable with, selling feels like control. It feels like you're protecting what you've built. But today, I'm going to show you why that one decision at the wrong time could do more damage than the market drop itself. And more importantly, how smart retirees structure their portfolios so they don't have to make that decision in the first place. When the market drops, most retirees don't panic right away. At first, they hold. They tell themselves, this is normal, stay the course, long-term investing, it'll come back. But then the market keeps dropping and something changes. The losses stop being numbers and start feeling real. The headlines get worse. This time is different. This could be a major crash, and slowly confidence turns into doubt until eventually you hit a point where you just want it to stop. And that's when most people finally sell, not at the top, not even in the middle, but at the bottom after the damage is already done. And what happens next is the part that almost nobody talks about. This is where things go wrong, because the moment someone finally sells, they feel relief. No more watching the account drop, no more stress, no more uncertainty. But here's the problem. Some of the biggest up days in the market happen right after the worst drops. And if you're not invested during those days, you don't just miss a small recovery, you miss the recovery. And most people don't even realize it happened. Here's a real example. I'm going to show you the JP Morgan chart on screen so you can see exactly what I mean. If you invested $10,000 in the S&P 500 and stayed fully invested from 2006 through 2025, it grew to about $80,600. But if you missed just the top 10 days during that period, your ending balance drops to $35,900, more than cut in half. Miss the 20 best days and it falls even further to around $21,200. And here's the detail that should stop you cold. 6 of the 10 best days occurred within 2 weeks of the 10 worst days. 5 of those best days came right after the worst drops. So the moment you feel the most fear, the moment that most people sell, is often right before the recovery begins. Think about that, not because you picked the wrong investments, not because you didn't save enough, but because you weren't invested during a handful of massive up days that you couldn't predict. And here's what makes this even more dangerous for retirees. This isn't just about missing gains. There's a second problem, and this one is even bigger. Even if you never sell at the bottom, you can still run into serious trouble if your setup is wrong, because retirement changes the game. If you're 30, a market crash is a setback. If you're retired, it can become permanent, because now you're not just invested, you're withdrawing. So imagine this, the market drops 20% and you still need to pull money out to live. That means you're selling assets while they're down. And that combination, market losses plus withdrawals, can quietly drain your portfolio faster than most people realize. This is called sequence of returns risk. Don't worry about the term. Here's what it means in real life. A bad market early in retirement can do far more damage than the same bad returns later, because you don't have time or new contributions to help the portfolio recover. And this is where most retirees feel stuck. If I stay in, I could lose more. If I sell, I might miss the recovery. That tension is exactly where bad decisions happen. So what do smart retirees do differently? They don't try to predict the market. They prepare for it, because the goal isn't to avoid market drops. That's impossible. The goal is to build a portfolio that can survive them without forcing you into emotional decisions. And it comes down to one idea: separate your money based on purpose. 3 simple buckets. I'm about 18 months from my own retirement target, so this isn't theoretical for me. This is the exact system I'm relying on to make sure I don't have to sell when things get ugly. I broke the whole thing down in a recent video. I'll link that in the video description. But here's what actually matters. Bucket number 1, this is your cash bucket. Cash, money market funds, short-term treasuries. This is what you live off when the market drops, so you're never forced to touch your investments at the worst possible time. And I want to be specific here, because a lot of people hear safe assets and think bonds. Bonds can absolutely play a role, but 2022 reminded us they're not a guarantee safe harbor. That year, stocks and bonds fell at the same time. Your cash bucket needs to be things that truly don't move with the market. Bucket 2, income and stability. This is where dividend ETFs like SCHD, dividend-paying stocks, REITs, and some bonds live. These are still investments. They will move up and down with the market, but they're designed to produce income and provide stability along the way. This is your bridge between safety and growth. And when your cash bucket starts to run low, this is where you refill it from. Bucket number 3 is growth. This is your S&P 500 or total market funds like VU or BTI. This is your long-term engine. Yes, it will drop, but here's the key. You're not living off this bucket. You're not touching it during downturns, you're letting it recover. And this matters more than most people realize because retirement isn't 5 or 10 years. For many people, it's 25, 30, or even 35 years. Part of your portfolio still needs to grow. When the market drops, this bucket takes the hit, but you're not forced to sell. That's the whole point. Now, beyond the bucket structure, 2 more things matter. First, rebalancing. And this is where most people freeze because buying when things are falling feels wrong, really wrong. But here's what rebalancing actually looks like in real life. Let's say your target is 50% in your cash and income buckets and 50% in your growth bucket. The market drops 20%. Now your growth bucket might be down to 40% of your portfolio, and your safer buckets have drifted up to about 60%. Rebalancing means trimming a little from your income and stability bucket, not your cash bucket, and using those funds to add to your growth bucket while it's on sale. That feels uncomfortable, but your plan already told you what to do before your emotions showed up, before the headlines got loud, before the stress set in. You're not making a gut call in the middle of a crash. You're following a process you built when your head was clear. So you're not reacting, you're executing. And that's the difference between investors who survive down markets and investors who don't. And finally, flexibility. Retirees who can adjust spending slightly during rough years put themselves in a much stronger position long term. And here's something most people don't realize. Research actually shows that retiree spending naturally decreases over time anyway, so small adjustments usually aren't a sacrifice. Maybe that means spending a little bit less in a year of a bad market. Maybe it means delaying a big purchase by 6 months. Small adjustments early can prevent much bigger problems later. None of this eliminates risk, but it removes the one thing that causes the most damage in retirement: pressure, because pressure is what turns a temporary market drop into a permanent mistake. Most people spend decades building their portfolio, but almost no time preparing for how they'll react when it gets tested. That's the difference. Retirement isn't about finding the perfect investment. It's about building a plan you can actually stick with when things get uncomfortable. If you want more simple, practical investing strategies like this, make sure you're subscribed because I'm breaking all this down in real time as I build toward my own retirement. Real portfolio, real numbers, real decisions. And check out this video right here detailing the one thing the rich do to retire 10 years earlier. And I will see you in the next one.